Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her website's jugglingdynamite.com and venablepark.com. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, RBC is saying there's going to be a recession, but don't worry, it'll be short. What's your opinion there?
Well, the norm for those folks is to not see recessions until they've already started, and then to assure everyone that they'll be short and shallow. So that's kind of the typical playbook. As we know, recessions officially are never declared many, many months later in retrospect by the National Bureau of Economic Cycles. The NEBR is the one who actually officially declares them, but that's always long after they've started. And so in real-time data, you have to do sort of independent analysis of key metrics. And let's face it, RBC is in the financial sales side of the equation, both for mortgages, debt, and financial products like stocks and equities and all that good stuff. So they're really not in the business of warning people that we're going to have, losses in any of those sectors. And so it's not surprising that they don't typically make the recession calls, and then if they do, it's always an assurance that it'll be short and shallow and you shouldn't try and do anything defensive. Central banks and politicians are very much the same sort of animal.
Now, I think it's probably the same people who are saying, don't worry about the inverted yield curve. The thing is, the inverted yield curve has worked as a warning of recession very accurately, hasn't it?
Yep, that's one of the things for sure. The down cycle, the downturns in the economy and bear markets are a recurring feature of economic cycles. They're actually very normal. What's been abnormal the last couple of decades is the extent to which central banks and policymakers have gone to try and stop them from happening and or truncate them quickly once they do begin. And they've really gone into all manner of, experimental tactics to try and do that. But what's happened, as we've seen in the last 22 years, is they have extended things periodically, but the bear markets are actually much worse in that environment than, average. So, the average bear market during a recession is typically about 42% decline over 16 months. Well, we actually, in the last, since 2000, we got two 50% plus declines that lasted over 18 months each. In terms of the recession and bear markets that occurred. And that was because, by stalling, by extending and pretending, by allowing speculative froth to get that much worse, you end up with extreme sentiment indicators in terms of risk-seeking behavior and also in terms of valuations and what people are paying for assets. And that always sets up for a steeper, deeper mean reversion period, and that's exactly what we've seen in the last 22 years. And what I find really amazing is, I was writing about this on the blog today, in 2000 I thought we were set up for a secular bear period, which is typically 15 to 20 years of market cycles which trend up, peak out, and then mean revert back, sort of taking back 100% of the expansion in the bear market. So you're kind of back to square 5 years later. Then you get another expansion and then another peak, and then peak to trough, you're back to about where you were. So that type of action typically has within historical secular bear periods, again, that always start from these extremes in valuation and sentiment, you typically get about 3 of these waves, which include the expansion and contraction cycle. 3 of those within a secular bear period that's roughly 15 to 20 years. Well, what you've accomplished this time, because of all these incredible interventions that I described, is that we've extended it such that now, 22 years after the peak of the stock market bubble at the most extreme valuations in human history in March of 2000, we're actually not very much off that again, because we saw that sort of run up to peak froth again in 2007-8, another big collapse, the second 50% decline, as I said. Then you get this really sort of long, drawn-out sideways, trying to get prices back up with all these gimmicks and QEs and boosting and margin and, slacking of the regulations and all that. Then you finally get us back up to really extreme valuations again by March of 22, again with the fiscal push, gifts and all that came in the pandemic, and then the extreme monetary intervention again. Well, it turns out by March of 2022, we're then back up to the most extreme valuations that we'd seen prior to the March 2000 high. So it's almost like 22 years of secular bear, we've accomplished nothing, and now we're back into the fourth. Well, if you count the crash that happened in March of 2020 with the pandemic, but that was an anomaly because it was so short and sharp. So we're kind of into the third or fourth, however you want to count that, cyclical bear market within this secular period. And although we've come off substantially from the high, if you look at it, we're maybe halfway through, potentially, the kind of mean reversion we would see, and that would be milder this time than we've seen in the past 2 other cyclical bears within this secular period. So I think, if we were to have the S&P, for example, fall another 20% or so, another 25% from the 20 it's off to date, that would be a pretty mild outcome in this environment. Same for the TSX. It's only off about 14 or 15% here because it had that big boost in the energy sector early in this year in 2022. Boost in energy and commodities in general really have levitated the TSX a little longer, but it's very reminiscent to me of what happened in the 2007-8 cycle when the U.S. markets peaked, in December of 2007. In fact, that's about when the U.S. recession was starting, and then you saw the TSX continue to, go up a little longer on the commodities late cycle stuff and financials, which is typical, they're late cycle as well. And then we had the kind of 15% decline into February of 2008, and that's when I was doing an interview with Jonathan Chevreau of the Financial Post, which I put a link to it on the blog today because it's quite comical almost to watch in retrospect, because there we were, 15% off the highs at February 2008, and him saying, well, isn't that enough? That's significant, and everybody says they're buying, so what's your problem? And I was saying, well, if you look at the secular bear structure, what you realize is that we're more set up for another, retest of the prior lows, so we could see the 2002 lows come back in here. We could see a mean reversion that's 50% from the highs, so if we're only 15% in, you probably made a third of the way through what you're likely to see. Which seemed extremely bearish to the average person at that point, but in fact that's exactly what happened over the next year. The TSX finally followed the S&P into a 50% decline. So I think I'm just having deja vu, and I must say that, thinking about this in 2000, I didn't think we would extend and pretend through 3 or 4 of these cycles for 22 years and sort of have got nowhere with all this financial pain and volatility that we've had. But here we are, and we're in it again. And like I said, I think we're only nicely started on the downside here.
I remember doing an interview with a person very much like you, a financial expert, who said, Canada is on the cusp of a recession. And my editor refused to run the interview, saying, look at the markets. They've never been higher. They've never been hotter. But they said that's setting up the situation for a horrible recession, which it was, especially in the U.S.
Well, in 2008, yeah, but absolutely, it's a very unpopular message, and I used to be a regular on some of the more mainstream financial channels, and when you would talk about that stuff, they didn't want that. Their sponsors didn't like that. They're sponsored typically by the oil and gas companies and the banks and the financial sales firms, and they don't want someone giving that kind of a bearish tone. So typically very little tolerated, which is, too bad, because to have only the bullish voices is a pretty skewed picture and of no benefit to anybody in the end, because if people are watching that thinking they're getting some kind of an insight on what they should be doing with their money, which is how they're pitched through those shows, is typically, a pretty dangerous thing. But what I also thought was interesting is that, you in the 2001 downturn, we actually didn't even get a Canadian recession, and we got a very mild U.S. recession. It only lasted from March of 01 to November of 01. It was about 8 months long that time, which was very mild and short, relatively speaking. And as I say, Canada avoided it altogether. But the stock markets in both countries still collapsed 50%. So this goes back to the stock market is supposed to be a leading indicator of the economic cycle. What we've discovered in the past few years is when you've had, again, during a secular bear, starting from peak froth in 2000, you had this kind of obsessive compulsive disorder around trading and risk seeking and people not taking measurements and acting like it was a casino and, levering up to go long and all that sort of thing. And so you get the stock market really being this self-fulfilling phenomenon in terms of, inflating asset balances for a while, household balances or corporate balance sheets for a while as these assets go up. And then when they collapse, it really that collapse in itself triggers the economy into a deeper downturn. And that's certainly what we saw in 2008, when the credit markets, the corporate debt markets blew up, and it spread to the stock market, and then it spread to the overall economy and the housing market. I think we're really in that kind of a precarious scenario again, because we've got this contagion that went from, free money, low rates, housing, speculation in financial assets, and now we're getting mean reversion in all those things altogether. House prices, Toronto home resales were off about 10% since March, and they're off 41% year over year. The prices are starting to come off the top two. We're seeing that in a lot of the indices that we follow in the real estate sector, but also like things like commodities, which are this very strong economic indicator in terms of demand. Well, of course, we had a spike of them on the Ukraine invasion, but now oil has come off again 29% since March. Once you had that big spike in the cost of fuel, that's typically been a precursor to recessions historically, and that's again, what we got oil spike way above $100 a barrel, and now we're back down. Agriculture index, the S&P agriculture index is off about 28% since mid-May. London's metal exchange is off about 33% since March. Copper and silver and nickel, which are all very critical metals to, as a barometer of global demand in manufacturing, they're all off about 20% year over year. The semiconductor index, which is another indicator, we had this shortage of chips, which everyone was talking about, and that how translating to a constraint in the amount of cars available. Well, the semiconductor index, the shares of the companies themselves, is off about 34% from November now, and back to where it was in November 2020, and that's way before the Ukraine invasion. So I think what we've had here is a typical inventory overstocking cycle that was accelerated by fear of shortages during the pandemic, and then fears from the Ukraine conflict. And so there was a lot of back ordering and ordering and triple ordering. A lot of people, credit became so cheap for people buying autos, and there was all these incentives to get people into cars. But in fact, we're seeing that, auto sales are way off the peak, and all the sort of insider, brokers and inventory, people are saying that they have a lot of vehicles now on the lots, and there's a whole bubble in the auto loan sector there, because again, money was given away based on very sketchy financial data, just to get product out the door. And now we've got a bunch of people starting to default on those loans. So that's what I'm talking about. There's a lot of things here that are really, as I say, interconnected, contagious, the extent to which they fueled an economic revival, out of the pandemic lows in March of 2020. The bill is really coming home now to be paid. And that bill, I'm afraid, is going to be I think we're already in recession. Certainly the U.S. data contracted for the first half of GDP contracted for the first half of 2022 to the extent that we can see it at this point. And I think Canada will follow. And the central banks, are still intent on hiking rates significantly from here, which we've never had before. We've never had a period where the stock market came off more than 20% and central banks were still intent on significantly more rate hikes because of this fear of inflation. They've never had a period where they were that afraid of inflation. But that inflation's always corrected by recessions. In every case, that's been the situation where you get the downturn in the economy ends up wiping out demand, ends up, crushing animal spirits and appetite for buying, and that contracts the economy and prices come down. So that really eliminates the inflationary problem, at least for a while. And I think that's what we're seeing in the commodity sector now, as I said, coming off as sharply as it has.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, if we do slide into recession, how bad do you think it will be in Canada, and will it be a different kind of animal than what might happen in the U.S.?
Well, it's we often follow the trend, but not necessarily the depth or duration. So I think that I'm worried that Canada is actually more vulnerable this time, whereas in the 2000 downturn, it was the U.S. tech overvaluation and over allocation of capital to that sector, which was really pronounced in America more than Canada because we just we had our Nortel, which was our own problem, of course, as that stock crashed. That was a huge component of the TSX. So that was very negative. But our economy at that point was not nearly as levered to that tech bubble, to the stock market bubble in that sense, as it was in the U.S. And then the second recession of the secular bear being the 2007-8 downturn into 2009. Again, Canada came into that. We had a bubble in the stock market in commodities, but we didn't have a bubble in the housing market. So we weren't as exposed or at risk as the U.S. economy at that point. But in fact, what happened was that, we still went down pretty much lockstep with them because we had this overzealous valuations in commodities and the whole expectation of China being insatiable, and that didn't, of course, turn out to be true. But this time, I think because our overvaluation in housing is obscene compared to most of the world and much worse than the U.S. today. We know that it's been driving about 10% of our GDP growth, which compares to something like 6% at the peak of the 2006 cycle for the U.S. That was an anomaly of extreme proportions to have that much of the economic growth dependent on the housing sector for the U.S. And of course, we know what happened with the subprime collapse and the real estate mess that followed. We have that much worse now in Canada than they had at the 2006 peak in the U.S. So I think we're more vulnerable this time to a worse economic decline than the U.S. So that's not great news, but I also think, Canada is very ill prepared for a rise in unemployment, which of course is classically part of an economic downturn. We're starting to see that again, with layoffs in some of the leading sectors like tech, certainly, and that's happening in Canada too. So, the other thing that's going on in the world, of course, is this remarkable trends in currencies right now, which has been very extreme. The U.S. dollar index, a basket of global currencies, the DXY, the U.S. dollar index, is above 107. That's a 20-year high. That's the highest since April of 2002. And so ultimately, that makes a lot of things very expensive for people who are dependent on U.S. goods. That makes it extraordinarily hard to meet payments in things like U.S. denominated debt, which many countries have borrowed. A period of low or falling U.S. dollar really lulled people. A period of low rates in the U.S., relatively lower than they could borrow in their own countries, lured a lot of borrowers internationally into taking out debt in U.S. dollars. Of course, as not only have the rates gone a lot higher, but the actual currency you need to exchange to make those payments has skyrocketed again at a 20-year high in terms of cost of service. The euro is almost at parity with the U.S. dollar, something we haven't seen since July of 2002. So, those are really important in terms of world trade and the flow of capital in the world. The U.S. dollar right now is, about $1.3 to the Canadian dollar. That's the highest again that we've seen since November of 2020. And so all of those things really suggest that there's this flight to safety going on. There's a preference for U.S. treasuries again, for the U.S. dollar. Cash is, it's interesting if you look at the sentiment right now, a lot of the investor surveys find that people are extraordinarily bearish, like households are, in terms of their idea about whether this is a good time to make major purchases, like whether it's buying an auto or a house. This is at all-time lows, like even lower than it was in 2008 in some cases. The pessimism is rampant, and yet the allocations to things like equities, to the stock market, are at pretty much the all-time highs. So this is what I'm talking about in terms of the risk to the downside here. So even though people are very pessimistic about the way that the economy is going and maybe the prospects for their upward mobility in terms of work and whatnot, what they find is that they've basically doubled down on this idea that there's no hope unless they can gamble their way out of it. And so they're sitting there in these assets that are crashing in value. And, what we know is that these cycles never complete until you get that retail finally capitulation, which ultimately will see, the median stock allocation drop to 40% typically, and cash come up significantly. So people start selling those risk assets after they've come off a lot. And that's when they really sort of, have lock-in losses. So again, coming into this particularly extreme cycle, thanks to all of the extend and pretend, we had equities and household portfolios about 66% at the peak. It was 56% as a max peak allocation in the 2008 downturn. We know how much that hurt people. So people are that much more exposed. Canadians are that much exposed because of the equity and the household bubble. So in terms of the housing market. So anyway, that's why I think, it's not a good story right now. I mean, we're getting a bit of a rally today. We should expect that. We had sort of 5 or 6 20% rallies in the last two cyclical bear markets within this secular bear since 2000. And you should see that. So far, we've had very muted rallies. It's been pretty shocking. So maybe the 4th rally we've had, but they've been typically, 7 or 8% rather than 18 to 20% kind of thing. So I think we should expect to see bounces, but I still think that we're going to have this bear market go on for considerably longer. We don't usually get to a bottom until the central banks have not only paused in their rate hiking plans, but actually moved to cutting again. And that's usually about 2/3 through the recession. Well, right now we haven't even had the recession officially declared or recognized or acknowledged. So I think we got several more months of this to go, and that people, have to be prepared for that.
Danielle, AMC has split their stock 4-1. Now, and of course the stock prices went up with that news, but are you buying into a bad deal there?
Well, that's a typical move that high-flying or highly speculative companies tend to do when basically they run out of buyers, because they, that particular company was the poster child for, the day trading mania that was going on a year ago, and all those stocks have come off so hard and wiped out a lot of their participants. And so they're always trying to now look for, new people to suck into the Ponzi. And they really do that by typically by splitting their shares, making them cheaper so that, people with less money can participate. So it's a classic, marketing scheme to attract people in. And, again, if you're looking at the prospects, because most of those businesses made no sense in terms of, if you looked at the fundamental analysis of those companies, many, many companies were only surviving because they could attract sort of the dumb money in, the buyers of their debt who were prepared to take massive capital risk with very, poor, return prospects in terms of the income they were receiving or the interest they were receiving on the debt for the risk they were taking. And also from a lot of companies were able to continually issue shares, and, they'd have all these people really willing to buy them, again, without doing math or concern for capital risk or adequate reward. And so now we're in this very much tightening phase in terms of liquidity drying up, and investor appetite always runs out of steam because they continually lose money, and they end up, basically revolted at the end and not prepared to try again. But right now they're still, as I say, maybe halfway through the down cycle this time. If we're lucky, maybe a third through. If we're looking at the typical mean reversion after the excesses we've seen. And so you should expect that a lot of companies are running out of money here, running out of cash and looking for other ways to buoy up or bring liquidity in. So they're, having to, just anything they can think up at all to attract people. So I think we'll see more of that kind of thing.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.